As we dive into today's market analysis, we explore the recent roller coaster ride of the Nikkei 225. Just this week, it hit a historic high of 63,000, only to face a swift correction fueled by profit-taking. Reports from Nikkei CNBC reveal that the index has since dipped below that critical threshold, impacted by a noticeable weakness in the semiconductor sector. Veteran market analyst Keisuke Asakura observed a staggering drop of 1,700 yen in a single session towards the week's close, attributing this pressure to rising interest rates. As the landscape shifts, the Nikkei's connection to global tech remains strong, but domestic rate sensitivity is now a pressing concern. Analysts are keeping a close eye on the 61,200 support level. A failure to hold could signal further declines. With pivotal Bank of Japan policy signals on the horizon, the near-term path for equity valuations is anything but certain. US dollar to Japanese yen pushed into the 158.40 range this week, triggering immediate speculation of official activity. By the end of this brief, you'll know why the 158.75 level has become the new tactical line in the sand for Tokyo and how the Ministry of Finance is signaling its presence. Yenzo Market, a former interbank trader and FX strategist, flagged suspected small-scale MOF intervention at the 158.50 mark. He characterized these moves as warning shots designed to punish speculators without committing to a full-scale liquidity dump. This volatility coincides with reporting from Japan Today, which confirmed ongoing coordination between Washington and Tokyo regarding currency stability. While the U.S. Treasury remains sensitive to large-scale unilateral actions, the door for orderly stabilization appears to remain open. However, the fundamental pressure on the yen remains acute. Minoru Uchida, a professor and former chief FX analyst at Mitsubishi UFJ, explained that the current mechanism is broken. Rising Japanese government bond yields are failing to attract capital back into the yen. Instead, the widening real rate gap continues to favor the dollar, rendering nominal yield increases ineffective. For traders, the takeaway is clear. The Ministry of Finance is no longer waiting for the 160.00 psychological handle to act. They are defending the 158.75 area with surgical precision to increase the cost of carry for short yen positions. Watch the 159.00 level as the next major trigger point. Looking ahead, the focus shifts to upcoming US PCE data. If inflation prints hot, Tokyo may be forced to escalate from warning shots to a full-scale market confrontation to prevent a technical breakout toward the April highs. Shifting gears to the tech sector, Kioxia, a leader in NAND flash memory, has revealed an optimistic first-quarter profit forecast of 86.9 billion yen. This remarkable turnaround is driven by soaring demand for high-capacity storage solutions in AI data centers. According to Nikkei CNBC, this rebound in memory pricing is not just a win for Kioxia but a significant boost for the Tokyo electronics sector. Business strategist Masaki Kamioka noted that Kioxia's preparations for a U.S. initial public offering are also capturing international traders' attention, potentially re-rating the entire Japanese semiconductor supply chain. Moreover, the convergence of Japan's robotics expertise with Silicon Valley's software is gaining traction, particularly with Fanuc's collaboration with Google to enhance factory automation through machine learning. For macro investors, this evolution from software speculation to tangible hardware applications is critical, with eyes on upcoming machinery orders data. The global fixed income landscape underwent a fundamental reset this week, and for the Tokyo macro desk, the implications for the yen carry trade are profound. U.S. 10-year Treasury yields surged to their highest levels since last July, touching the 4.7% mark following a hot producer price index print and the Senate confirmation of Kevin Warsh as the next Federal Reserve Chair. This Warsh shift signals a decisive move toward inflation discipline in Washington, creating a persistent high-yield environment that essentially forces the Bank of Japan's hand. Simultaneously, the Japanese government bond market is signaling its own regime change. The benchmark 10-year JGB yield recently hit a 29-year high, testing the 1.1% threshold as domestic traders price in a more aggressive normalization path. The catalyst here is the release of the Bank of Japan's April policy minutes. According to reporting by the Japan Times, board members explicitly discussed the necessity of a June interest rate hike to counter inflationary pressures stemming from the weak yen. This marks a significant shift in the BOJ's reaction function. The central bank is no longer just monitoring currency volatility. It is actively looking to use the overnight call rate to defend the yen's purchasing power through the FX pass-through channel. Domestically, the Japanese financial press, including Nikkei Shimbun, notes a growing divergence between local institutional players and global hedge funds. While international macro funds are aggressively shorting the JGB curve, betting on a rapid move toward a 1.5% terminal rate, domestic megabanks remain cautious. These local players are managing massive duration risk and are hesitant to buy the dip until they see clear evidence that Governor Kazuo Ueda can navigate a hike without triggering a disorderly spike in yields. This has left the long end of the JGB curve unloved and vulnerable to further volatility. For traders, the June hike scenario is now the central gravity for US dollar to Japanese yen. The yen's sensitivity to the 10-year yield spread between the US and Japan remains the primary transmission channel. If the BOJ does not deliver a clear hawkish signal or a concrete plan for quantitative tightening at the next meeting, the market is positioned to punish the yen regardless of how high JGB yields climb. Keep a close watch on the upcoming national CPI data. A print above 2.5% will likely cement June hike expectations, potentially squeezing the crowded short yen positions. The key level to watch is the 1.15% mark on the 10-year JGB, a breach that could trigger a broader liquidation in Japanese equities as the cost of capital begins to shift. By the end of this brief, you will know how the escalating tensions in the Strait of Hormuz are evolving from a headline energy risk into a systemic naphtha supply shock threatening Japanese industrial margins. While oil prices capture the headlines, the real pain for Japan is manifesting in the petrochemical supply chain. The most visible market signal of this crisis came not from a trading floor, but from the supermarket shelf. Japan Today reported that the snack giant Calbee has been forced to shift to monochrome, simplified packaging for its signature potato chips. This isn't a branding choice, it is a direct response to a critical shortage of naphtha-derived plastics caused by the maritime instability near Iran. For traders, this is the canary in the coal mine for Japanese corporate earnings. The macro numbers are increasingly precarious. While Brent crude has seen volatility, an expert panel on India Today recently warned of a scenario where oil hits $108 per barrel, triggering systemic energy shocks across Asia. Japan, which imports nearly 99% of its fossil fuels, is the most exposed major economy in this scenario. Naphtha is the foundational feedstock for Japan's massive petrochemical industry, feeding into everything from automotive components to electronics and food packaging. A notable divergence is opening between official government rhetoric and the reality on the ground. The Japanese analysis channel Political Economy Summarized has critiqued the current government's stance, noting that while the Ministry of Economy, Trade and Industry, or METI, claims naphtha supplies are sufficient, the actual behavior of Japanese firms suggests a desperate scramble for raw materials. This creates a disconnect. The official data may look stable, but the operational costs for the topic's chemicals and food sectors are spiking. For global macro investors, this is a margin compression story that the broader market has yet to fully price in. While the Nikkei 225 has benefited from the weak yen's boost to exporters, those gains are being offset by the rising cost of these petroleum-based inputs. If the Strait of Hormuz remains a flashpoint, the trade balance data will continue to deteriorate, putting structural downward pressure on the yen regardless of Bank of Japan policy. The forward-looking trigger to watch is the Ministry of Finance's next release of customs-cleared trade statistics. Specifically, look at the import volume versus value for petroleum naphtha. If volumes drop while values surge, the supply-side squeeze is entrenched. The critical level for the broader macro trade remains $108 on Brent, A breach there likely forces a defensive rotation out of Japanese industrial staples and into heavy energy-hedged positions. This matters for the Nikkei 225 and yen-denominated risk assets because it directly impacts the geopolitical risk premium baked into Japanese semiconductor and defense stocks. Following the high-stakes summit between Donald Trump and Xi Jinping in Beijing, traders are recalibrating Japan's strategic position. The Financial Times reported that President Xi explicitly warned Trump that Taiwan remains a non-negotiable red line, even as Trump characterized the resulting business discussions as tremendous. The presence of heavyweights like Nvidia's Jensen Huang, Tesla's Elon Musk, and Apple's Tim Cook at the Beijing dinner, as noted by CNBC, suggests a pragmatic, deal-oriented approach from the Trump administration. For Tokyo, the concern isn't just trade friction, but strategic relevance. TBS CrossDig, in collaboration with Bloomberg, analyzed a potential paradigm shift where Japan could be downgraded from a core partner to a mere bargaining chip in a broader US-China grand bargain. For the trade, this puts a spotlight on the Trump Trade 2.0. If Japan is sidelined in favor of direct US-China dealmaking, we could see a retreat in Japanese defense names like Mitsubishi Heavy Industries and increased volatility in the semiconductor supply chain, specifically Advantest and Tokyo Electron. Investors should monitor whether the LDP, the ruling Liberal Democratic Party, pivots toward a more independent regional security posture. The next key level to watch is the 38,000 mark on the Nikkei. Any signs of Japan being decoupled from U.S. tech policy could trigger a sharp repricing of the Japan-U.S. alliance premium. In a transformative move for Japan's defense industry, the government is contemplating the export of Type 88 anti-ship missiles to the Philippines. This marks a significant shift from decades of self-imposed restrictions under the three principles on transfer of defense equipment and technology. Reports suggest that Mitsubishi Heavy Industries, MHI, is poised to benefit from this new proactive defense posture. While MHI has recently reported strong profits, analysts warn that stock volatility is tied to uncertainty regarding mid-term order outlooks. With Japan's defense sector poised to evolve similarly to South Korea's, there's a structural shift from a domestic procurement model to a competitive, export-oriented framework. As we await confirmation of the Philippine deal and the Ministry of Defense's budget requests, the future trajectory of Japan's defense exports will be critical to watch, as any specific allocations for joint development projects could serve as a major catalyst for the sector.